Sri Gurupyo Namaha children. Welcome to Online Teaching Academy Ekalaiva. Class 11 Business Studies. We are going to learn a lesson Sources of Business Finance. So we know what is finance. Finance is nothing but money. So in this lesson, an overview of various sources from where business funds can be procured for starting as also for running a business, and the advantages and limitations of various sources of finance, factors which determine the choice of a suitable source of business finance are going to be seen in this lesson. Finance is called the lifeblood of any business. So we know very well business is concerned with the production and distribution of goods and services to satisfy the needs of the society. So for carrying out various business activities, definitely a business requires money. So therefore, finance is called lifeblood of any business. So finance is called lifeblood of any business. The requirement of funds by business to carry out its various activities is called business finance. So a business cannot function unless adequate funds are made available to the business. For example, if an entrepreneur starts a business, for starting a business alone, he cannot use his finance. So he needs finance to carry out the activities, that is to continue his business, to run his business successfully in various stages. He may need finance. So the requirement of funds by business to carry out its various activities is called business finance. The need for funds arises from the stage when an entrepreneur makes a decision to start a business. So once you want to start a business, definitely you need money to start a business. So a financial manager, first of all, he has to make clear assessment of the financial needs. A businessman or an entrepreneur or the person who is responsible for assessment of finance has to make a clear assessment of the financial needs, and he has to identify the sources through which they can raise the finance. So first of all, he has to make assessment, then he has to identify the various sources of finance to run the business organization. And the financial needs may be categorized into fixed capital requirement and working capital requirement. Let us see what is fixed capital requirement. So, in order to start a business, funds are required to purchase fixed assets like land and building, plant and machinery, and furniture and fixtures. So, these are called fixed assets. So, these are long term investments and they cannot be resold. This is known as fixed capital requirements of the business. So to meet all these expenses, to meet the purchase of land and building, purchase of plant and machinery, purchase of furniture and fixtures, a business needs finance. So this fund is required to purchase these fixed assets. So it is called a fixed capital requirement. So the fixed capital requirement will not be the same for every business organization. So different business units need varying amount of fixed capital. It depends upon various factors such as nature of business, size of business, etc. Suppose if it is a trading company or a retail shop, the fixed capital requirement will be lesser than a manufacturing company. A manufacturing company may need large amount to be invested in the procurement of fixed capital, that is fixed assets. And what is working capital requirement? See, every business needs funds for its day-to-day operation. So to meet day-to-day operation, every business needs finance. To meet the day-to-day operations, the finance required by the business firm is called the working capital. So this is known as working capital of an enterprise, which is used, so that finance is used for holding current assets such as stock of material, that is stock of inventory or raw material, and for meeting current expenses like salaries, payment of wages, and payment of taxes and rent. All these include comes under working capital. So to meet all these working capital requirements, our business may need finance. So the amount of working capital requirement varies from one business concern to another. For example, an organization operating on a large scale needs more inventory, isn't it? To be maintained, the inventory should be maintained at a higher level. So, a large organization may need higher amount of working capital. Small organizations may need less amount of working capital. And the requirement of working capital increases. When it will increase? With the growth and expansion of business. Suppose if a business wants to expand itself, it may need more working capital, isn't it? It is quite natural. So there are fixed capital requirement and working capital requirement. Sometimes, for example, the working capital requirement may be constant for the companies which are selling goods throughout the year, the same product. But for the companies which are selling seasonal goods, sometimes, during the off season, the working capital requirement may be less. And during the peak season, the working capital requirement may be more. So it depends on the size of the organization and this seasonal operations and business cycle fluctuations also. And the sources of funds can be classified. The raising of funds through various sources can be classified on the basis of time period and on the basis of ownership and on the basis of source of generation. So let us see one by one. On the basis of time period, it may be classified into long term source of finance, medium term source of finance, short term source of finance. These long term source of finance uh, may be got for a period exceeding 5 years. So it fulfills the financial requirements of an enterprise for a period exceeding 5 years. If it is more than 5 years, if the amount is borrowed, if the amount is raised for more than 5 years, means it is called a long term source of finance. So, what are those long term sources of finance? Such as shares and debentures, long term borrowings, and loans from the banks and financial institutions. So, these are called long term sources of funds. Such financing is required to acquire fixed assets. Usually, these long term borrowings are got to purchase the fixed assets because they require large amount to be invested, and it is a long term investment also. That is why these long term sources of finance are got for a longer period or exceeding 5 years. Then medium term source of finance. This type of sources of finance are required for a period more than 1 year but less than 5 years. So these finance are raised for more than 1 year but less than 5 years. So this finance is generally borrowings from commercial banks and public deposits. That is, the business organization may invite the public to deposit in their firm. That is, receiving deposits from the public. And lease financing. Through lease financing also, medium term loans are raised. Medium term finance are raised. What is lease financing? Here, the owner of the assets grants the to use his asset for a particular period of time for a certain amount of return. The owner of the asset grants his asset to be used by a third party for a certain period of time. For that period of time, the third party, that is whoever is getting lease, has to pay to the lessor a certain amount of money. Here, the person who grants his assets to be used by the third party is called the lessor. The party who is getting the assets to use for a certain period, he is called a lessee, and the lessee will be paying some rent to the lessor. And the loans from financial institutions, so other than commercial banks, medium term source of finance are raised from the financial institutions also, like Industrial Development Bank of India, Life Insurance Corporation of India, Industrial Credit and Investment Corporation of India. These are all the financial institutions which can provide loans to the business firms. And what is this short term source of finance? This type of finance is required for a period not exceeding 1 year. That is, it has to be repaid within 1 year. It should not exceed 1 year. Within a year, it has to be repaid. You can take the example of trade credit, loans from commercial banks, etc., are the sources of short term finance. Trade credit is nothing but credit between two traders. That is, the supplier may grant goods or services to the buyer on credit for a certain period of time. That is, it has to be paid within 1 year. This is called a trade credit. So these are all the short-term source of finance. Then the source of funds can be classified on the basis of ownership also. The first one is owner's funds. What is this owner's funds? Owner's funds means funds that are provided by the owners of an enterprise. So owners in the business may be sole proprietors, partners, shareholders, kartas in case of joint into families. These persons are called owners. Okay, so they can invest their money in the business. So that is called owners funds. And apart from this capital invested by the owners, this owners funds includes profits reinvested in the business. What is this profits reinvested? See, the undistributed profits means the whole profit will not be distributed as dividends to the shareholders. Some portion of the profit may not be distributed also. That portion of profit which is not distributed to the shareholders as dividend, it is called a undistributed profit, or it is also called retained earnings. So that profits may be reinvested in the business. So this is also called a owner's fund. It is invested in the business for a longer duration. This owner's funds is not refunded to the owners of the business during the lifetime of the business. Only at the time of closing down of the company only it will be refunded. And issue of equity shares and retained earnings are the two important sources of owners fund. That is the capital as well as the profits, that is the undistributed profits, are called as owners funds. Then what are borrowed funds? This is another form of raising finance by the business concerns. So funds raised through loans and borrowings. Getting loans and borrowings from the public are called borrowed funds. So it is raised through loans from banks, loans from financial institutions, issue of debentures. They are like a creditor, that is issuing of debentures, and public deposits. Public deposits means inviting deposits from the public, and trade credit. So these are all the sources raised through borrowed funds. So generally, it is costlier than the owner's funds. Why is it so? It is raised for a fixed period of time and on the basis of some security. So the business firm has to mortgage some assets of the company with a bank to get the loans from bank. And in case of debentures and public deposits, they have to pay a fixed rate of interest and the principal amount also to be repaid after a specified period of time. So generally it is costly when compared with the owner's funds. And on the basis of sources of generation, how a business can generate funds from internal sources and from external sources. What are internal sources? Internal sources are those which are generated from within the business. Within the business, the sources of funds can be generated. How can it generate? By collection of receivables. What are receivables? Amount yet to be received from the buyers or consumers or from the debtors. Okay. And disposing of surplus inventories. Surplus inventories means excess inventories has to be disposed of. So through that also they can generate funds. And plowing back its profits. Plowing back means that is reinvesting in the business, that is the undistributed profits which are obtained from the business can be reinvested again in the business itself. This is called plowing back its profit. But these internal sources can fulfill only the limited needs of the business. And we will see the external sources of funds. These are generated from the outside the organization. That is why it is called external sources of funds. They are also costly as compared to internal funds. Why? Because it has to mortgage the assets as security while obtaining the funds from external sources. You can say the example of issue of debentures for borrowing from commercial banks, they have to mortgage the assets. And so we have come to the end of this session, children. So far, we have studied what is business finance and how the business finance is classified. That is the financial needs of a business, how it is categorized, and classification of sources of funds we have seen so far. So we will meet in the next class, children. Thank you. To receive our online lessons, press the subscribe button and get the updated videos. Thank you, children.